The intention of the Main Street lending facility.
Okay, great. So for smaller companies, there was the Paycheck Protection Program. And for companies that have access to the bond market and are investment grade rated, we have corporate credit facilities. And then there's a large group of very important companies, very diverse, different sectors, different needs, just very different. And those are, for them, we have the Main Street facility. And our intention is that if there are creditworthy companies, to the extent there are creditworthy companies in that space who are not able to get credit from the banking system because of the pandemic, we want to be there to provide that credit. So that's what we've been working on. It's significantly different from any other undertaking we have been working on here, particularly because that space is, by definition, it's a space where commercial banks really are the key form of liquidity and of lending. And the bank credit agreements are always negotiated, so there isn't a really high level of standardization. Each one's a little bit different. So we've got to find a way to get to those borrowers, get through their credit agreements, and get them funding. And we're working through the banking system to do that. We have now registered lenders, so that the facility is effectively open now. The lenders are registering, and they can now begin to make loans. We're encouraging them to do so. And those loans will soon be transferred. 95% interest in them will be transferred to the facility. So we're there, we're, as I think we've shown, as we go with all these facilities, we are learning. No one's ever done this exactly, and so we've been constantly taking feedback from lenders and borrowers, and we'll keep doing that. And that's true for all of our facilities until we feel we've got the facility that can do the best job.
Okay, so that's an unconventional set of monetary policy that you're utilizing, given the unconventional nature of this health and therefore economic crisis that we're facing. We also see other banks, Japan and Europe, trying to control inflation targets using unconventional means, such as yield curve control and negative rates. Do we have empirical evidence to support deploying these tools in the United States as you see it?
There's a split. I'd say the evidence is mixed on negative rates. There are those who believe negative rates are quite effective, and there are those who see the results as somewhat ambiguous. I think here in the United States, we've looked at it carefully. We looked at it during the long expansion that ended in February and chose not to deploy them in the United States. Lately, the FOMC has looked carefully at negative rates and continues to see pretty broadly across the committee that negative rates are not something that we think is appropriate for the U.S. economy, at least at this time. And it's not something that we see ourselves resorting to. Instead, we look at ourselves using asset purchases and forward guidance. In terms of yield curve control, as you pointed out, it's currently being used by a couple of central banks around the world. And that's just, rather than buying assets, what you're doing is you're saying, we won't let the treasury curve at a certain level move above something. And if it starts to move above that level, the rate moves above it, then we'll buy treasuries to drive the rate level back down. The United States actually did that from the late 40s into the early 50s. I'll just finish, sorry. It's something we're really just educating ourselves on at this point. It's not something we have at all decided to do.